If you've spent any time looking into investing, you've likely heard the pitch: buy an asset, hold it forever, and let it pay you cash every single month without you having to sell a single share. It's an incredibly appealing idea. Financial influencers aggressively market this strategy as a way to easily pay your bills while you sleep. But that hype creates a huge problem. It leads beginners to vastly underestimate the actual capital required to make this work. This chart shows the actual math. If you invest $50,000 into a standard dividend portfolio, it won't replace your salary. It outputs about $146 a month, enough for phone bills, but nobody is retiring on it. So today, we are going to strip away the marketing hype. We are going to look at the exact metrics that actually determine a dividend's safety and outline the concrete math required to build a meaningful income stream in 2025. Investors who ignore these numbers often find themselves chasing unsustainable yields, a path that leads directly to high-risk assets that frequently collapse. First, we need to establish exactly what a dividend is. When a company makes a profit, it can either reinvest that money back into its operations, or it can share a portion of those profits directly with its shareholders as a cash payment. These cash payments are traditionally distributed every quarter, meaning 4 times a year, though certain specialized funds are structured to pay out monthly. This formula illustrates the fundamental metric for measuring these payments, the dividend yield. You calculate this by dividing the annual cash payment by the current stock price. That gives a percentage, telling you exactly how much income you earn relative to the capital you invest. This brings us straight into the most common beginner mistake, the yield trap. When people want passive income fast, they often sort stocks by a highest yield percentage and dump all their money into broken, failing companies just because they see a massive 10 or 12% payout. The math catches up to them quickly. A struggling company eventually has to cut that unsustainable payout. When they do, the stock price crashes. The investor loses their passive income stream and a huge chunk of capital all at once. Prioritizing the safety of the underlying asset is always more important than a flashy high percentage yield. To avoid that trap, you have to look past the yield percentage and check a second, far more important number, the dividend payout ratio. This pie chart visualizes that metric, showing you exactly what percentage of a company's total earnings are being paid out to shareholders versus what they keep for the business. As a general rule, a payout ratio under 60% is safe. That leaves the company with enough retained capital to weather economic downturns, pay off debt, and continue growing the business while still rewarding shareholders. The danger zone begins when that ratio pushes past 80%. When a business pays out nearly everything it earns, there is no margin for error. One bad quarter means they can no longer afford the dividend. Buying a stock with an 80% or higher payout ratio is simply trading immediate gratification for the high statistical probability of a future dividend cut. Even when you find a safe company, there are strict operational mechanics to actually getting paid. Simply owning a stock today doesn't guarantee you'll receive the very next cash distribution. You have to factor in the ex-dividend date. This is a strict ownership deadline set by the company's board of directors. This timeline illustrates the absolute rule. You must purchase and hold the stock before this specific date to be eligible for the upcoming quarterly payout. If you buy the shares on or after the deadline, you miss the block entirely. You still own the asset, and you'll be eligible for future distributions, but you are completely locked out of the current quarter's cash. Failing to track the ex-dividend date means you effectively tie up your invested capital for 3 full months without seeing a single cent of return. Because evaluating individual payout ratios and tracking dozens of ex-dividend dates takes constant management, the most effective route for beginners is buying diversified dividend ETFs. This instantly spreads your capital across hundreds of companies, neutralizing the impact if any single business cuts its dividend. This comparison matrix breaks down the exact options, starting with the 2 gold standard traditional ETFs, SCHD, the Schwab U.S. Dividend Equity ETF, and VYM, Vanguard's High Dividend Yield ETF. Both provide secure dividend yields between 2.8 and 3.5%, pay out quarterly, and charge incredibly low management fees, just 0.06%. Then we have the high-yield alternative for investors wanting maximum monthly cash flow, JEPI, the JP Morgan Equity Premium Income ETF. It offers a 7 to 8% yield paid every single month. Notice the mechanism. It generates that yield by selling call options against its holdings, a strategy that prioritizes current income over market appreciation. That option strategy is the specific trade-off. To generate that massive monthly yield, JEPI trades away the upside of the stock market. You get high income now, but your original investment is severely capped in how much it can grow over time, and you also pay higher management fees. Knowing how these funds work allows you to map out a specific strategy based on your phase of life. Let's start with the younger investor who has a 15-plus year time horizon and makes smaller monthly contributions. This strategy relies on a dividend reinvestment plan, or DRIP, to turn small monthly contributions into a self-sustaining asset. This growth chart illustrates the mechanics of DRIP in action. Instead of taking your dividends as cash to spend, DRIP automatically uses those payments to purchase fractional shares of the ETF. Those new shares then produce their own dividends, creating a rapidly accelerating loop. If you invest $500 a month into a traditional fund like SCHD and reinvest every dividend, you could realistically build a passive income stream of over $3,000 per month by retirement age. For the wealth builder, the trade-off is accepting zero usable cash in hand today in exchange for massive compounding financial freedom decades later. Now let's pivot to the capital-rich investor. This is someone who has a lump sum, say $200,000, and needs immediate income to offset living expenses right now. For this segment, a long-term DRIP strategy doesn't make sense. Instead, they deploy that capital into a high-yield product like JEPI, or a hybrid portfolio combining SCHD and JEPI to maximize their current yield. A $200,000 portfolio yielding 5% generates about $10,000 a year, giving you $833 a month in immediate, usable cash. The trade-off? That investor must accept their initial $200,000 will not grow aggressively. This decision tree maps these options directly to your goals. If your priority is long-term wealth over 15 or more years, you choose SCHD or VYM paired with DRIP. If your priority is immediate usable cash to cover expenses today, you lean towards JEPI or a hybrid approach. Successful dividend investing is never about chasing the highest yield percentage. It is entirely about determining your specific time horizon, picking the financial vehicle that matches it, and letting the math do the work.